Good afternoon. Thank you for taking the time out and joining us in person for those who are here and online for those who are participating online. Could we get the presentation up on screen, please? While the presentation is coming up on screen, uh, you would have got jute bags with you, right? Those are pretty good jute bags, so please avoid the temptation of throwing them on stage. Uh, you can use it, right? Throwing them on stage will not help you much. So, for those who are interested, you could look up the source of the meme as well. It's called the Ballets of Buster Scruggs. It's on Netflix. It's a quite a hilarious thing for those who are interested in those kind of parody westerns. Yeah, cutting to the chase. FlexiCap returns last 1 year minus 3.24%. Benchmark, which is Nifty 500 plus 3.52%. First time. So why are we using these memes and pictures? Because a picture is worth 1,000 words. It conveys a lot of things. So I could bore you with statistics and with what is called gyan, and it would put you off to sleep. But I'll try and explain things with anecdotes, with stories, analogies, so that things become more visual and interesting uh, in the discussion. And it's not poking fun at anyone, but the all the poking fun is for the investment team and not directed at anyone else. So please don't take offense, and I apologize in advance for any offense that I may cause. So what are the confessions I have to make? These confessions are known to people who have been around for a long time with us as investors, but people who have joined in the past 12 to 24 months would not be aware of these, and I'll convey them. So the first confession is that this is not the first time that I have underperformed, or the team has underperformed, or the fund house has underperformed uh, in the equity schemes. So this is a snapshot from 2017. Neil spoke about this briefly, where the scheme returns on a 1 year basis were roughly 29.5%, whereas the index was up 36%. So it's not the first time. That is the first confession to make. The second confession is that it is not the biggest magnitude. So currently it would be roughly 6-7%, whatever difference between benchmark and the scheme performance. 2007 there were riots in our office. So we were underperforming the benchmark by 30%. So uh, all the people who would be in the client facing role would have a miserable life, and internally they had a revolt on thing. And uh, I actually went to our founder Parag Bhai and said, see, this is I'm doing what I'm doing. If you think this is not good, then you could get someone else to manage the money. And like, people would have been very happy if that were to happen, the client facing people in our own organization, because clients would say market is up some 65%. What is your portfolio doing? It's up just 30-35%, and so much cash is lying around, and biggest bull run we are seeing in the market, and you are doing nothing. So it is not the biggest magnitude, trust me when I say that. 2017, some people actually called up again, called up Neil and said, remove this person. What is the kind of guy you have managing the schemes for PPFS? You have so much potential. You have a good brand name. You have a mutual fund license and all that. What are you guys doing? People have been very kind to me, saying that recent underperformance is because we have grown very large, because the fund size has gone up to whatever 25-26,000 crores. But again, confession in true spirit of disclosure and honesty, 2007 we were 150 crores, a massive underperformance. 2017 we were less than 1,000 crores again. So I don't need large AUM to underperform. I can manage that at any AUM size. I can do that with or without foreign stocks. So right now there is limit on foreign stocks, foreign investing. Uh, 2007 there was no foreign stocks. 2017 there was foreign stocks available. Any limit you want to invest. So all sorts of combinations are there. Again, I don't know whether it's because of AUM, because of foreign stocks, not foreign stocks, but I can do it at any size, any AUM. And the last part is the scary part. Don't run away. So it's not the last time again that this has happened. This will happen in the future as well, guaranteed. Right? Why is that a guarantee? Because when you do things which are different from what the index does, then you will have a return which is different from what the index will give. Uh, Sometimes it will be better, sometimes it will be worse, but it will never be exactly what the index does. And when you are doing what is called active management, which is doing something different than from what the index is doing, you hope to do better than the index over a cycle, but not all the time. That is the nature of what we do. Uh, I realize that with the presentation, I am cutting into the Q&A time a bit, but I think this is important for uh, a couple of reasons. So one is that it will convey what I have to convey in a more structured manner. And the second is most of the questions are around this. So three groups of questions that I could ascertain from the form that we had put out and people uh, generously put their questions in. So one group of questions is around the fund performance. Why is it underperformed? What are we doing to correct the performance and all those things? The second group of questions has been around individual stocks, especially the foreign stock ownership that we have, the ownership in Meta, which is one of the favorite questions, Google or Alphabet, Microsoft, Amazon. Why did we? Why do we own them, or why did we not sell them, or things around that? And what is happening with the foreign stock investment limit? If it does not open up, how does it affect us, and what is our thinking around that? So I'll take a bit extra time as compared to the usual pattern that we have each year and dwell on this so that we can address most of those questions upfront, and then later on we'll take curated questions from Neil Borate, who's kindly agreed to moderate the Q&A session for us. These are the questions which people have filled up on the online form. And once we are done with those, we'll take live audience questions, which will obviously not be curated. So there are mics up front. So once the moderated Q&A is over, you can come up and then ask your question. Yeah, so let's dive into this. And I can empathize with the questions that are there. So just before the formal part of the session, we were chatting informally, and one gentleman came up to me and said, "What's happening? It's been a year or more. I've put money in your scheme, and the thing doesn't seem to go up. Even if the NAV goes up somewhat, then it again comes back down. What's happening?" And I can empathize with that. So it's not just this gentleman. My wife and daughter are politely sitting in the first row and also wondering why they are not wealthier today as compared to 1 year back. So they also ask me the same questions. Luckily here, you get to do it only once a year. They ask me every day. So that's the downside. So, and I can empathize with this because after all, at least directionally things should be going well for you, right? If you sign up for a weight loss diet, okay, sometimes the weight may be flat, sometimes weight may come down slowly, but you don't expect weight to increase on a weight loss diet, right? So here you have given money to us for it to grow over a period of time. You don't expect it to remain completely flat or marginally downward or whatever. What is happening? And these questions have been like a very loving and caring parent uh, questioning, scolding a child after a bad report card, right? Uh, your marks are not good. What are you doing about it? why did this happen? Number one, that is the first question, why did this happen? And second is, how will you ensure that this will not happen in the future and how you will do better the next year? Okay, now this is obvious. So far, we are clear on this aspect. 3 outcomes after this question happens. One is that the child behaves like a good child, as is to be expected. Okay, Papa, I will not watch Netflix so much next year. I will study more. I'll do all my homework assignments and we will do better. I'll get better marks next year. So, equivalent here, we could be all 4 of us would go to Neil and stand up before the audience and say, next year we will not watch Netflix, we'll read more annual reports, we'll attend more conference calls, we will read more books, and we will try and do better. That could be one thing that we do next year. The other thing could be that Neil gets very angry and says, I should punish you, I should cut your pocket money, or you will get only one coffee in office, or we'll cut your salaries or something like that. That is the second part. Both don't sound very appealing to me. So what I'll try and do is, I'll try and take the third approach. Firstly, I'll try and explain to people in this audience and Neil that performance actually is not bad and performance actually is very, very good. That is first attempt that I'll make. And secondly, to whatever extent performance is bad, it is the teacher's fault because all the questions were out of syllabus and meaning no blame remains with the investment team. So let's get right into it. So the subjects of physics and chemistry are easy in life, right? So in chemistry, if you combine 2 atoms of hydrogen with 1 atom of oxygen, at the end of it, invariably you get water. It never happens that after you combine these 2 atoms, you get olive oil or you get castor oil, right? That never happens. In market, sometimes you get castor oil and it takes your digestive system for a toss. That's the issue with equity investing. Equity investing is more akin to this. And again, to explain to Neil, I have a very handy analogy. Neil has been each year for the last 9 years saying PPFS believes in the law of the farm. So now I have a farm analogy to tell him how there is no fault that attributes to the investment team. So what does the farmer do? A farmer ensures that the soil quality is good, that plowing is done on time, that the seed quality is good, proper fertilizers are given, proper hydration is given, water is given on time, pesticides are put at the right time, all the weeds are taken away. That is what the farmer can do, right? But what if there's a flood one year? What if there's a drought the other year? What if there's a crop disease which suddenly breaks out in a region and which destroys all the crop? What can the farmer do? So Neil, what can we do? Right? So what are the good seeds, water and fertilizer of investing? Neil touched upon this briefly in his talk. But firstly, we have been saying this for 9 years, not just today, that we try and seek out to invest with good quality promoters and managers. We try and invest in great businesses as defined by high returns on equity, where there's some competitive advantage, which are preferably asset light, where there's low leverage, and where there's attractive valuation. These are the good seed, water and fertilizer of investing. So those of you who have read this book, 7 Habits of Highly Effective People by Stephen Covey, know about these 2 circles. The bigger circle in life, not just relating to this subject of investing, but generally, the bigger circle is what is called the circle of concern. It could be various things that could affect you: the political system in the country, the infrastructure in the city, uh, pandemics like COVID, and all sorts of things. Those are things which affect your day to day life and even longer term life prospects. But most of the things you can do nothing about. Within that larger circle of concern, there is a small circle wherein things are there which you can actually do something about. So, can we do anything about Russia Ukraine war, price of oil, interest rates, recession coming in US or no recession coming in US, uh, semiconductor shortages or semiconductor excesses, shortage of containers, glut of containers? Can we do anything about that? Answer is no. Can we do anything about the stock prices? Answer is no. What can we do something about? The same things which I spoke about in the earlier slide: promoter quality, business quality, valuation, and stuff like that. So, again, the reason, and again, I'll compare this journey with the weight loss program that I spoke about. If you sign up for a weight loss program, you don't expect your weight to increase. But when you are on a drive on roads like this in a hilly terrain, going from point A to point B, many a times your car will seem to be going in the reverse direction as compared to the destination that you see in front of you. Many a times, instead of the car going up, will be going down on a road, because that road goes round and round and round before it finally reaches the destination, which is very, very akin to equity investing journey. I'll give specific examples as we go along, but keep this in mind. This is the reason why we keep insisting on long-term returns. People who have been invested with us for some time and have attended plenty of these meetings would know that we have never gloated on short-term results or even on long-term returns. We have never said, oh, look at last 6 months performance, look at last 1 year performance, how great it is. So when we were not ecstatic, when 12-month performance was very good, you should not be depressed when 12-month performance is not that great. Because it's the nature of the thing. It's nothing that is unique or which is happening for the first time. In WhatsApp forwards, most of us fantasize about these kind of things. What happened? What would have happened if I had bought Wipro 30 years back? What would have happened if I had bought Google when it listed? What would have happened if I had bought Bajaj Finance 15 years back? Meaning, I would be incredibly wealthy, right? So we keep fantasizing about those things. And it seems like all you had to do was buy them and hold. Very simple, right? So let's look at what those journeys actually look like when you go about doing those kind of investments. So this is the journey of Alphabet and Google. Great return, right? And the biggest drop seems to be in recent times. If you look at the magnitude, the blue line went up significantly and came down significantly. However, that is not the biggest drop. At the bottom of the chart, the red lines that you see are what are called the drawdown charts, or the percentages drop from the previous highs that have been seen in the past. In 2009, there was something funny that people like Lehman Brothers, Bear Stearns, AIG, and all these guys did. And Google had its stock price fall some 80% or so. Right? Nothing that Google did or did not do in 2009. And these 20, 30, 40% drops have been very, very regular in these kind of companies. And some of you may be tempted to think that this phenomenon is only for foreign stocks or only for tech stocks. So let's leave Google aside for the time being. Let's go to an Indian company. An Indian company which has done very, very well for people who bought this company. And all these company names are for illustration purposes. I'm not recommending a buy, sell, or a hold or any of these, just to illustrate the steep falls that can happen even in great quality companies when you are holding them. So, Bajaj Finance has had 90% kind of drops many a times. It has had, meaning 20%, 25% is very, very normal. 40%, 60% drops also happen quite regularly. So, these are just two examples that I've given, but you can plot stock price graphs of many of these companies, and the returns and the results will be very, very similar. A lot of people have asked, why did you not sell these stocks last year? If you have invested with us, expecting us to know what is the bottom price of any stock and what is the peak price of any stock, and to enter at the bottom and exit at the top, then I think there's a severe mismatch in the capabilities that we have and your expectations. And I don't mean to mock people here, but that is not something that I know how to do. What we try and do is, we try and identify good quality companies. We try and invest in them at reasonable valuation. So what is reasonable valuation? There can be questions and we can discuss that and we can talk about that. But talking about exiting at a high price or anticipating that the stock price will fall, many times the falls come out of nowhere. So someone working at Google or someone who was a technology analyst analyzing Google will not know that somewhere Lehman Brothers is doing something or Bear Stearns is doing something and everything is going to come crashing down. We don't know that some virus is spreading somewhere in the world and the entire world will go in the lockdown suddenly. All these kinds of things keep happening and one has to be prepared for those. Neil spoke about this, but I'll reiterate. This is not something that we have recently put up on the website because 1 year has been bad. This has been on the website since we launched the scheme in 2013. Who is this scheme for? Who is this scheme not for? If you have 5 years, please invest. If you don't have 5 years, please, we are not the right people to invest with, because I don't know what the NAV will be 6 months from now, 1 year from now. Those are very, very random things that happen, and interest rates go up, come down, recessions come and go, and COVID lockdowns happen. Various kinds of things can happen. Yeah, same thing. There's a section on why you should not invest if some things are not meant. Our fact sheet has had this red marker. It's oval now. It used to be rectangle earlier, but essentially saying the same thing. It's suitable only if you have 5 years. How long is long term? Minimum of 5 years. Longer the better. Lot of you would have seen the web series Scam 92 on Sony Live. Right? That's not the interesting thing about the web series or the 1992 scam. The most important thing about the 1992 scam, to my mind, is that the high that BSE Sensex saw around that time, 11 years after that, we were in negative territory. So BSE Sensex was 4,200 in 92 or thereabouts, and it was 2,850 in 2003. After 11 years, you had negative returns from equity indices in India. US markets have seen similar trend, 10 years of zero return. So equity as an asset class is not a substitute for your bank FDs or for your liquid funds or short-term debt investments. It's meant for your longer term retirement goals, your home purchase loans, your home purchase goals, or for child's education and things like that. These are meant for only long-term goals, not for short-term needs. And let's put things in perspective. And this is the part where I argue that the results are not really that bad. If you look at it from the frame of 1 year, it's minus 3.5 versus plus 3.5. If you look at over 3 years and 5 years, returns are pretty decent on a relative basis and on an absolute basis. Nothing to see here if you just zoom out a bit. And the more important thing, again, coming back to this whole noise around Indian stocks versus US stocks, should you be, and very funnily, in the questions that we have received, roughly half the people are worried that our foreign limit is capped, that we are not able to invest more abroad. That is one set of unit holders. The other set of unit holders are worried that why do we have any investments abroad? US markets are falling. We should have sold everything and been in a 100% equity kind of scenario. And both are contradictory in terms, right? So look at 3-year returns for FlexiCap and we look at 3-year returns for TaxSaver. So 3-year returns for FlexiCap, 22.74 per annum, and 3-year for TaxSaver, 23.43. Not much of a difference, right? This is akin to rounding error. Both are roughly 23% on a 3-year basis. I'm not saying this relationship will exactly hold true in the future or anything like that. What I'm saying is stop worrying, right? So for 10 years as a investment house, personally, I have been part of the team which had managed only Indian equities, 2003 to 2013. Last 3.5 years, we have been managing tax-saver fund without any foreign investments. We can manage investing that way as well if foreign stocks are not allowed. If foreign stocks are allowed, that's a good thing. Not because it gives higher return, but because of another thing. It gives a bigger opportunity set and it potentially lowers the volatility. Yeah, this is the chart. Depending on the starting point and ending point, you can make the case in various forms. You can make the case for investing in India or investing US, but it converges most of the time. So some of the time, you will feel that the orange line is doing well. Orange line is US S&P 500. Blue line is Indian equities. And before you point out the currency effects, both are in Indian rupee terms. So again, nothing to see there. No worry on the front of exchange rate differential and anything like that. Over a whatever, wherever this chart begins, somewhere in 92 or thereabouts, over long periods, it's intersected 1, 2, 3, 4, 5, 6 times. Both converge, again separate, converge, again separate. So it's not that necessarily if you choose one market over the other, you will get higher returns. It's not that. Since the launch of the scheme, we have been saying the reason to invest abroad is to get opportunities in companies that are otherwise not available in India. So you don't have equivalents of Google, Facebook, Microsoft, Amazon, these kind of companies in India. You don't have too many upstream energy companies in India. You don't have too many innovative pharma companies in India. So it gives you a larger opportunity set. That is one. Second is it protects you from country specific volatility. So a GST introduction, a demonetization, a border tension with China, these things affect Indian stocks but do not affect global stocks that much. That has been the reason to add foreign stocks, not necessarily to get higher returns, because returns can be achieved in any market, and depending on the starting and ending point, that can seem like a good place to be in. Okay, so that completes the taking stock of the 1 year performance and putting it in perspective. Try and look at it over slightly longer term horizons, things seem to be more or less okay. Now we'll come to stock specifics, because there have been a lot of questions around the foreign stocks that we own and what is happening in those companies. Three broad worries can be there. Three broad questions can be raised. Not every fall in a stock price is a chance to buy, because sometimes the stock price falls and remains down forever, right? So the question is, are these stocks where the share prices have fallen, like a Enron or like a Kingfisher Airlines? So Enron was a out and out fraud where the books were cooked and people went to jail for that. Has some sort of a fraud come out in Alphabet, in Microsoft, Amazon, or Facebook? Answer is no. There's no fraud. Kingfisher was a very, very leveraged company. They were not able to pay salaries on time. They were not able to pay interest on their bank loans on time. Are these four companies very, very leveraged companies, or losing huge amount of money, not able to meet their cash flow requirements? Again, the answer is no. So let's put that aside and let's not worry about that. Even if a stock has fallen 20%, 30%, 40%, it doesn't mean that there is anything that is wrong at the very basic level with those companies. The other worry that people have is that some people have been around in the markets from late 90s onwards, and they have seen the earlier dot-com boom, where you had all the what were called K10 stocks in India, and all the DSQ softwares and Silverline and Pentafor and all sorts of companies which were going at crazy valuations. And forget those companies, even companies like Infosys and Wipro were trading at very, very crazy multiples. So let's look at Infosys. This is a slide from Infosys. So the first red circle that is there, they had a profit after tax of 286 crores, right? And they had a market cap of close to 60,000 crores. This is late 90s. The price earning ratio was more than 200 times. This is Infosys in the year 2000, early 2000. March 31, 2000. Now look at what happened to the stock price. After peaking out in early 2000, the stock crashed and did not reach the earlier level for 6 years. So for 6 years, people were losing money on the stock. And mind you, there was nothing wrong with Infosys per se as a company. The company kept growing its sales and profits over the 6-year period. It is just that the starting valuation was so steep that people had a huge opportunity loss by holding on to Infosys, and they only broke even after 6 years. So did we have that kind of a situation in the Alphabet, Facebook, Microsoft and Amazon in the last few years? I would argue not. So rather than just make a general statement, we will look at the individual finances of all these four companies, and we'll try and make sense of what the valuations were like, what the valuations are like now, and what prospects do we see for these companies going forward. So we'll cover those individual companies separately, but the third broad question that comes to mind, and a lot of people worry about this, is that in the technology space, the pace of disruption is very, very fast. Something which is very strong or seems to be very strong today, a new competitor comes in, and that company gets wiped out. So Yahoo was a dominant internet company in the late 90s, and today hardly anyone has Yahoo as their home page. It is still existing today, but people typically would go to Google or go to Gmail or go to Instagram or Facebook, or Yahoo is not their first internet company that they think about. MySpace, of course, I don't think it is there anymore. I haven't even checked. So MySpace or Orkut or these things are not around anymore. So this is the other thing people worry about. Are the companies that we are owning shares in, are they getting disrupted? Again, I don't think the answer is yes. I think these are very, very strong companies, and we will discuss each of these companies separately. Before we start discussing each of these companies, I've just put on screen some of the broad trends that we are seeing in the world today. Most of the people in this room today would be subscribing to either Hotstar or Netflix or Z5 or Sony Live or something like that. And if not subscribing, then would have YouTubes on their phones or on their connected TVs at home. And if you get used to streaming content on demand, you are not going to go back to linear TV saying, I'll sit in front of the TV set, I'll press a button on the remote, and I'll watch whatever serial or movie that the channel is broadcasting at that point in time. There's no going back. Once you get used to streaming, you will continue operating in streaming. Same way, all of these trends, once you get used to buying grocery at the press of a button and things getting delivered to your home, then it feels cumbersome to go to the uh, big store and fill up your cart and stand in the line at the checkout counter. So e-commerce, streaming, uh, AI, cloud computing. So all of these trends which are there are trends which have existed before COVID, got accelerated during COVID, are taking a breather now, but are trends which will continue in the coming decades as well. It's not that we are going back in time. And the companies that we own are very, very strong players in some of these areas, and they will be on the right side of the trends that are happening. So let's discuss the first company, Alphabet Inc. or Google if you prefer. I'm sure more than 60-70% of the people in this room have an Android phone in their pockets. That's what the statistics say. Uh, on those phones, there would be apps of Gmail, there would be apps of YouTube, there would be Google Maps. This company probably knows more about you than your sibling, your parents, your spouse, or children. They know where you have been to, they know all the emails that you have received, they know what stocks that you own, where do you bank, what searches do you make. So, in fact, if you have watched the movie Red Notice on Netflix, uh, the threat to one of the person was that don't come near me, otherwise I'll disclose your search history to everyone. Right? So Google has all your search history with it. So I don't think anyone can seriously argue that this company is going to be disrupted, or that this company is in a space where Orkut or MySpace were. I don't think there's any serious argument here. It's in fact getting stronger and stronger each day. So earlier, you may think that Google search has been existing forever. You may think that Google Maps has been existing forever. But under the hood, the changes that are happening, you tend to take for granted, but you don't realize the significance of that. So Google Maps was just a place, was just an application where you could see the maps. Then there was navigation, where you could use it to drive from one place to the other. Then that same navigation changed from driving a car to riding a bicycle to walking to taking public transit. And now that is a platform for advertising. It never was a platform for advertising, because now you can have location specific advertising, or you can have it can operate as a toll gate, where every time you take a ride on a Uber or a Ola, if that company has tied up with Google Maps at the back end, they get a small cut because their maps are being used for that. And down the road, those same maps are useful to some extent in their autonomous vehicle thing. So search has gone through various iterations. So with each passing month, with each passing year, actually their competitive advantages and moats are becoming stronger rather than getting weaker. So the question of, were we owning bubbly stocks, were we owning very overvalued stocks? I don't think so. So people ask us, why did you not sell it in 2021? It was at 28 times earnings for a company which is monopolistic. Now, a lot of Indian companies I have great respect for and are great companies. Take any of the good companies in India, let's say Nestle, Asian Paints, HDFC Bank, one of the companies that we own. All of these are great companies. But if you were to actually ask me which company has a bigger moat or a competitive advantage, I would think Google has a bigger moat because it's a monopoly. The other good companies are maybe dominant companies in their space, but they are still in a competitive market. So a 28 times earning kind of valuation in 2021, when these companies technically peaked out in this cycle, it was not really expensive at that point in time. So it was not like owning Infosys in late 90s or early 2000. Microsoft, same thing. So they are the dominant desktop operating system. They have a subscription based office productivity suite now, with uh, all the Excel and Word and PowerPoint being uh, software as a service offerings in many cases. Uh, they are a they are the number two cloud service provider, and they have a advantage in the corporate sector as compared to Amazon because of their corporate linkages. Amazon has advantages in the tech space. So they are a very dominant company and growing quite well. Again, was it a bubble kind of company 12 months back? I don't think so. So there is a lot of times people ask, what did you learn from your mistakes last year, or would you have done something differently? Uh, if there was a learning to be had, I would have seriously tried to learn it. But here, I think it's just a random outcome where uh, the macro environment became tough and the stocks got sold off. Something like in 2009 or something thereabouts. Like people are worrying about corporate advertising spending or corporate tech spending and valuations, and some people were leveraged maybe, and there was a sell off in the stock prices. I don't think there's any significant learning from the investment process per se, because these were not overvalued companies. And if we were to go back in time, and if I had the same information in front of me, probably the outcome would be the same. Amazon, with each passing month, year, their delivery times improve, the price competitiveness improves. Uh, Big players in their cloud computing piece, they each item of their P&L account where they have a expense, they try and convert that to a profit center. So logistics used to be a big cost for them. Now they are running most of the logistics in house, and now they are trying to do it for other people. So it's a very dominating company, and uh, if you are just going by price earning ratios, this may seem like a bubble like company last year and now, but we will talk about it. Uh, why, at least in our opinion, we don't think it's a bubble like company. Why we think it's an attractive company to invest in. So, broadly, these are the business segments that it operates in. The company currently has a market valuation close to $1 trillion. in the coming 12 months, there is a chance that they may do 100 billion revenue in cloud computing itself and maybe earn 25-30 billion dollars from that. And it's a fast growing business. So arguably, the entire company's valuation can be justified on AWS alone, right? So some people may value it at, let's say, 700 billion, someone else may have a 850 billion valuation, but it's a very significant part of the company's profits and prospects. A lot of other things come to you which are not fully monetized or where they are not currently making profits. We can go on talking about this company probably for next 2-3 hours, 4 hours. So I'll be moving on, but people are familiar with this company. I don't need to talk too much about it. So we'll straight away move to valuations. I have not deliberately put the net income and EPS and P numbers here because some of their businesses make losses, but even a loss making company does not have zero valuation, right? So their retailing business currently makes losses, but they will have around $500 billion turnover from that retailing piece. The 1 trillion market cap that is there for Amazon can be justified probably only on AWS. So again, I don't think we were in a situation like Infosys where we bought and continued to hold in a bubble kind of scenario. Which comes to our most popular company of this year. So if there was a award to be given, that will go to this company, Meta Platforms Inc. Yeah, it is the ITC of 2022. How many people in this room do not have WhatsApp installed on their phone? Raise of hands. Not a single person. Come on, there has to be someone, right, who does not have WhatsApp on the phone. Okay, so at various points in time, people have called the death of Meta Inc., saying now they have changed the privacy policy. They will, my data is no longer secret. They will use it for advertising. Uninstall WhatsApp and install Signal. None of you did it. So every now and then people say, oh, now TikTok has come. That is the death of Instagram. No one goes to Instagram anymore. No one, Facebook is for old people. No one goes on Facebook anymore. Right? So the trouble is that whenever quarterly numbers come out of Meta, you don't see that in the thing that they put out, either in terms of their revenue or the daily active users, monthly active users. Even Americans who till now were getting by on their iMessage on their iPhones have not now started coming to WhatsApp, right? So the products are well known. I don't need to explain Instagram, Reels, Facebook, WhatsApp, Messenger, Oculus, and all these. Oculus, maybe we'll talk about Oculus when we discuss Metaverse. Oculus and Metaverse we'll discuss. But Microsoft's, Meta's prospects are well known when you see the quarterly numbers. If you go by the mainstream media saying uninstall Facebook, uninstall WhatsApp, uninstall Instagram, the narrative is very strong, and Mark Zuckerberg is a favorite person for people to call and bash up. So he will be called to Senate and he'll look awkward in those hearings, and all sorts of things will keep happening. But let's look at the numbers. 2013, the company had a revenue of less than $8 billion. 2021, $257 billion. How is the company earning advertising revenue when no one is on Facebook or Meta products? This company was valued at 23 times earnings last year in 2021. Right now it's valued at 9 times earnings. Did we buy into a bubble and are we continue to hold on in the bubble? I don't think answer is yes. Is this company like Kingfisher Airlines where they have borrowed a lot of money, they will go bankrupt? Answer is no. Is this company like Orkut or MySpace? Answer is no. Facebook, despite all the narrative, has all-time high number of users currently. WhatsApp is now growing even in North America, which was traditionally not adopting WhatsApp. Instagram is growing well. TikTok has taken some market share in terms of time spent on it, has taken some share of the ad revenue as well. They are somewhere around 10-15 billion dollars, Ronak. Any ballpark? 10 billion, right? $10 billion in revenue, annual revenue. 10 billion versus 282 billion revenue. So TikTok is there, but doesn't mean that Meta has died. So what is the worst thing that has happened to Meta right now? That 39 billion profit has fallen to 29 billion profit in last 1 year. That is the worst thing that has happened, and that's why this huge stock price crash and all this gloom and doom kind of narrative around Meta. Why has that profit fallen? Of course, one part truth, part narrative is iOS changed its privacy settings and their ads are not as effective as pointing out correlation between the ad and a purchase decision and stuff like that. That has had some impact. The other is 10 to 12 billion dollars. They are either investing in metaverse or they are burning up in metaverse, depending on your point of view. But largely they are spending a lot of money, roughly, I would say, a quarter of their profits, let's say, hypothetically. If they had $40 billion profit and 10 billion they are blowing up in metaverse, then a quarter of the profit they are flushing down the toilet, let's say, worst case. Because of that, the company has been bombed out. So what is our stance on it and why are we continuing to own it? Firstly, who's the biggest loser when these share prices fall? The three founders are still significant shareholders in the three companies. Larry and Sergey in Alphabet, Mark Zuckerberg in Meta, Jeff Bezos in Amazon. Microsoft now is a diversely held company. I don't think one can still call it a company with Bill Gates as a founder or something like that. So in the first three companies, the founders lose a lot of their wealth if the stock price comes down. Much more than what you and I are agonizing about for the past 45 minutes. They are the biggest losers. The employees, a lot of them who get paid in ESOPs and paid in their company stock, they lose a lot of money. So it's not that they are enjoying the stock price coming down. Let's rewind and look at what happened in the last 2 years or 3 years. When COVID struck, physical stores were shut completely, not just in India, almost the world over. The entire physical demand moved to the online demand, e-commerce demand. Massive shift towards streaming, massive shift towards digital advertising. A lot of these companies were not prepared for a huge amount of growth. Amazon had to expand its physical network to 100%, meaning doubling of their capacity in 2.5 years. Just think about it. Doubling the number of trucks, number of employees, warehouse capacity, everything in 2.5 years. In the middle of pandemic, when it's difficult to hire people, difficult to get people out of the home in such an environment. So in such an environment, there was a big shift towards these digital companies. They benefited a lot. We as shareholders benefited a lot. in 21. These companies are giving back a part of those gains in 22. That is one big change that happened in the past 2.5 years. It's not that there's anything fundamentally wrong with this group of companies. More or less, they are doing fine. So let's come to metaverse, the most hated thing about Meta Platforms Inc. I would argue that you need not have an opinion on metaverse to invest in this company. Whether metaverse succeeds or fails is largely immaterial at this point in time when you are either owning the stock or buying the stock. I'll tell you why. Firstly, these side bets are nothing new. This has been happening for ages. Earlier, it was just Facebook. They acquired Instagram, which was a side bet at that point in time. They acquired WhatsApp, which was a side bet at that point in time. They were trying to do something like a stable coin in crypto, in case people have forgotten. They tried to launch a stable coin called Libra, later on called DM. And the project didn't work. They had to scrap it. So be it. So, this kind of creating side bets has been in the culture of all these four companies. Google had acquired Nest, those connected thermostat companies, for $3 billion. What happened to that? I would term it as a failure. I don't think that significantly contributed anything to Google, but such things happen. They acquired YouTube at one point in time, which was a side project. They acquired Maps at some point in time, which was a side project. So some side projects succeed, some don't, and it is the nature of things. So inherently nothing wrong with their trying their hand at metaverse. If it succeeds, we'll benefit from it. If it does not succeed, they are blowing up roughly a quarter of their profit on that. Remaining 3/4 of profits are there for us as shareholders. Is that too much? Are they spending too much money on it? I think the answer is yes. Probably they got a bit arrogant in the growth in 2021 and thereabouts, and they overestimated their profitability, which they have admitted. So they are cutting costs. All four companies are cutting costs, are trying to right size given the new economic environment. But this kind of side project is nothing new. That's what I wanted to convey. And again, if you are a shareholder for 3 years or 5 years or 7 years, metaverse won't even matter in your holding period, because the success or failure will probably be known after that. Some small impacts will start to be seen immediately, because something like Oculus, which is their headset and which is an alternative to buying something like a Xbox or something where you can play games on the headset in a virtual reality or a augmented reality world. So those kind of things will start coming immediately, but largely we'll know after many years. And I'll give an example of that. Look at the year. This is 2009. This is when Google's self-driving car project was started. 2009. This is now called Waymo. 2020, which is after 11 years, they actually launched the driverless ride-hailing service in Phoenix, Arizona. It took 11 years. So many of these projects are long drawn. So the metaverse investments today, we will not probably know for next 5 years, 10 years whether they were useful, not useful. I may think they are useless. Mark Zuckerberg thinks they are wonderful. Doesn't matter. We can have difference of opinion. But what is a fact is that the company is still throwing out a lot of cash. And it's very cheap. It's not obsolete. And we can continue to own it. For those who are interested, this is a wonderful book on the journey that Google did in the self-driving car thing. And just think about it while we are on it. When we are buying Alphabet today, and when I showed you those numbers, uh, 30 times earnings or 20 times earnings, we are not paying anything whatsoever for these side projects. Just think about it, if this becomes successful, where they become a global Uber company without the driver, where they buy the cars in bulk so that they get the cost advantages. They get to buy the fuel in bulk, maybe initially petrol or diesel and later on electricity. Insurance, they can self-insure or buy insurance in bulk and have a cost-effective alternative to the human-driven cars. I don't know whether they'll succeed or not. They are already operating in 3 cities. But the important part is that we as public shareholders are getting all these side projects for free. Uh, we are not paying anything for these. And those are like free lottery tickets. A lot of the times they have paid off. So, for example, YouTube paid off big way for us, or cloud computing paid off in big way for Amazon. And failure is part of the story. So, a lot of you may not even remember this, but there was this Fire phone that uh, Amazon had launched, a spectacular failure. So, some projects will win, some projects will fail. We are not paying any valuation for those side projects. We are buying them only on the cash profits and the things that we can evaluate. Did these companies become too arrogant? I think the answer is yes. Do they need to do some spring cleaning? I think the answer is yes. It's easy for us to say spring cleaning. A lot of people are losing jobs, which is kind of sad, but they are responsive to what is happening in the environment. If the revenues are not growing, they will not let the costs grow. So don't worry about the environment. There are responsible people heading these organizations, and they will do what is required. Overseas investment limits, Neil mentioned. Right now, there's no update to give. We cannot buy more shares by remitting money outside. We are buying more shares from the dividends that we get abroad. But the interesting part is, all 4 companies that we own, or we own 5 companies, Suzuki is the 5th one, but all these 4 US companies are buying back their stock. So even though we can't buy them, they are doing share buybacks on our behalf. So don't worry, we are able to benefit from the low prices that are there currently in those markets. And whether overseas limits are there or not, we will, given the environment that we are given, we will keep attempting to find good investment ideas and invest in those. So I'll be completing 20 years as a professional investment manager early next year. In 20 years, it's only for a short period of time that I had the opportunity of investing abroad. Rest of the time, we have been investing in India. So it's not that we are new to investing in India. Tax Saver Fund is doing just fine investing only in India. If the limits are increased, that will be a great thing. That will give us more flexibility. If that doesn't happen for some time, that is also okay. I'm sure as and when the macro environment permits, the limits will be enhanced. Thank you for a patient listening, and we'll dive into questions. Thanks.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.